Welcome back to our CCP exam prep series. Today we're diving into a critical skill for any cost professional, economic decision analysis. This is how you move beyond the price tag to make holistically sound investment choices. Let's say your company needs a new machine. Option A has a lower price but higher annual costs. Option B costs more upfront but is cheaper to run. Which one is truly better for the bottom line? That's what we're unlocking today. First, we must understand the full economic landscape. The purchase price is just one piece. We consider opportunity cost, the value of the next best investment we forgo. We focus on the incremental cost, the actual cost difference between options. And we ignore sunk costs, which are irrelevant to future decisions. We also operate in an environment shaped by inflation, taxes, and crucially, depreciation. Depreciation is a non-cash expense with a real cash impact because it reduces taxable income. Whether using straight line or an accelerated method, it lowers tax payments, affecting our project's cash flow. And to compare those cash flows over time, we need our core principle, the time value of money. A dollar today is worth more than a dollar tomorrow. We translate cash flows across time using equivalence and standard discount factors, like finding a future value with F/P or a present value with P/F. But we must be precise with our rate. There's a key distinction between a stated nominal interest rate and the actual effective annual rate, which accounts for compounding frequency. Always use the effective rate in your formulas. Now for the decision maker's toolkit. Your benchmark is the minimum attractive rate of return, or MARR. The first major method is net present worth, or NPW, often called net present value, NPV. It converts all project cash flows into a single sum in today's dollars. For competing projects, you choose the one with the higher NPW. If comparing costs only, you choose the option with the lower NPW of costs. It provides a clear, absolute dollar answer. Method 2 is equivalent uniform annual cost, or EUAC. It spreads all costs into an equal annual amount over the project's life, perfect for comparing alternatives with different lifespans. You simply choose the option with the lowest EUAC. Method 3 is rate of return, or ROR. This is the interest rate where the project's net present worth equals 0. A project is acceptable if its ROR exceeds the MARR. When comparing two options, we perform an incremental ROR analysis on the extra investment to see if it's justified. Method 4 is the benefit-cost ratio. It's the present worth of benefits divided by the present worth of costs. A ratio greater than 1.0 means the project is economically acceptable. A final, simple but flawed tool is the payback period. While easy to calculate, it ignores the time value of money and cash flows after the payback point. Use it only as a supplementary check, never as your primary method. The true power lies in synthesis. Use NPW for an absolute dollar value, EUAC for an annual cost perspective, and ROR for a percentage return. By applying these frameworks, net present value, EUAC, and ROR, you build a robust, quantitative case for your decision. You're not just finding a number, you're building a framework for confident, economically sound recommendations.